Hey, good afternoon, everyone. Good afternoon. How's everybody?
Good afternoon,
Good
Professor. Good
afternoon,
afternoon.
Professor.
Yeah, hi. How are you,
Good
Peter? How
afternoon,
are
sir.
you,
Good
Eva?
afternoon, Professor.
How are you, Eva?
Good afternoon.
Good
Good.
afternoon.
Sir, I'm gonna have to leave
Yeah,
class a little early today.
yeah.
I have, a-
Um,
I have a little emergency, so I won't be able to stay the full
okay.
session.
All righty. No problem. Yeah, do whatever is necessary. All righty. So, a couple of things I want to inform you before starting. So yesterday, and I guess also we talked about this on Tuesday. Um, we are already into topic two. I mean, topic two has started already. Um, okay. That I already have it opened here. Okay. So, well, officially we go by the scheduled, main lecture, and the main lectures has been already, deep into topic two. So in our as of
Okay,
Tuesday,
y'all.
was someone saying something to me, or was just the background noise? I guess it's just the background noise. So as of today, right? As of today, I think these are factoring part two, three, four. Those are the assigned videos for today. And um, uh, on Tuesday, I believe the videos assigned were financial statements part one, part two, and factoring part one. So that means you must be all caught up all the way to this point, right? You must be caught up all the way to this point. And again, just don't rely on the collaborate session, because collaborate session is it's bound to be behind. It's bound to be behind the main lecture, because it's meant to be a reflection and review. So we're not going by the collaborate session. We go by the main lecture, and according to that, and also we you are there has been some talks about the connect, because the connect practice problems are automatically assigned according to schedule. So since we are into topic two, uh, we're in connect. And uh, I guess I talked about this also in this class a little bit. Now, always, there are people who are still awaiting their books. They ordered it like, end of August or early September, but the books are all back ordered, so they don't have it, they didn't have them when you ordered. So I believe I got an email a couple of days ago from the publisher that the books are ready. So I think they are. If you are waiting for your uh, books, then I think they have just started shipping it out. But then, your Connect Chapter 2 problem is due. Chapter 2 problem is due October 8th. So then, what can, what do you need to do? What do you have to do? Well, I said, first of all, they always give, a 2 week trial access as courtesy. But then, if the first person has already used the activated, let's say, trial access on August 31st, then 2 weeks, it only, starting from that, the clock doesn't start when you activate it, but the clock starts when the first person activates it, and the clock ticks for the entire for everybody, right? So if the first person activated it on August 31st, then about September 13th, that's already 2 weeks. So then after that, if you are just trying to activate it on after September 13th, you can't even do that. And trial access doesn't require any code. So I requested a super code which extends it for another 2 weeks. So by using this super code, you can, so for example, if someone activates it today, regardless of, when each individual activates it, so it doesn't matter when an individual activates it. If the first person activates it today, then it's going to run for only 2 weeks. So you better get started before, so that you will be, if someone has already taken advantage of it, leaving you behind, and if you start too late, you will, the door is already closed. Okay, so this is only, so what you need to do is everything is explained in the course information. If you go to course information, and as you scroll down, there is the information about Connect site link. So just click on that and follow the instruction. The instruction says clearly here. The instruction says use your BMCC email. I think by entering the access code, use your BMCC email. Okay, to sign up. Name on the Connect must match your roster name, so it must be exactly in the last name, comma, first name order, so that they will align, right? The names in the Connect and the names in the roster will align. So you must, enter BMCC email, and then once you once you enter your email, this bar will light up, and then you click it and follow and enter. It will ask you to follow the instruction. It will ask you to enter the code. Normally, if you have your book, you have the access code, and you can enter the access code, your own access code there. But since you don't have the book yet, again, used books don't come with the access code. Okay, used books don't come with the access code because it's been already used. Now, so and as explained in this memo, right? Where is this one here? No, not that one. There are lots of postings copied from the previous semesters, and that I recycle or not. But this one, this is only temporary, right? This is again, a 2-week extension, temporary, 2-week, trial access. Eventually,
are you supposed to be sharing your screen?
Say that again.
Are you supposed to be showing us?
Oh, am I? Oh, I'm sorry. So I wasn't sharing my screen. Yeah, I wasn't sharing my screen. I'm sorry.
Okay. No. I thought you weren't supposed to.
No. I forgot to share my screen because my mind was, like kind of in a rush, and normally I share my screen. So again, yeah, this is this email. You got this email, right? You got this by email, and it's there posted in the announcement. So you need to constantly check the announcement for any updated, memo. And in this, again, it's only temporary, right? And because all the exams, midterm, quiz 2 final will be on Connect, and all these, chapter problems are on Connect. You need your own access code eventually, right? So hopefully your book arrives within the next 2 weeks. So once this, temporary access expires, then you will have, you will continue to be able, you will still be, you will still continue to be on Connect. You need, definitely your own access code, right? Own individual access code. But this access code is for up to 100 people. I, requested, because I have 4 sections. In each section, the maximum enrollment is 25. Of course, in some sections there are more, some sections there are less. But again, so I will have to show you this again. Again, if you go to course information, right? Scroll down in course information. There is, instruction about the Connect. So please use your BMCC email, and when you create your profile, just enter the last name first, right? Last name, comma, first name, so that it will align. The roster in Connect will also match the roster, your BMCC roster, because if your first name and last name are mixed up, if you mix up that order in one of them, right, then your names won't match in both rosters. So make sure you always put your last name first, comma, first name, right, and then click on that link. It will take you to the Connect, and then use BMCC email. Once you enter your BMCC email, this bar will light up. It will turn blue, and then you can begin. Okay. Don't click on this. You cannot sign in until you have an account, right? Because you cannot sign in until you have an account. First, you have to sign up to have an account, right? So that's why you need to sign up first. Okay. So that's basically what I needed to talk about. Now, so let me because in our last class we couldn't quite finish the how Federal Reserve it's an extension of open market operation. So we understand open market operation already. Last time I just couldn't show you this because it was enlarged, it was blown up to like 500%. So I got it back here. So this is what happens in open market operation. I told you under normal circumstances, I mean in ordinary case of monetary policy, especially in expansionary monetary policy, the instrument, the Federal Reserve basically buys back treasury securities from the commercial banks, and but during the quantitative easing, I told you, not only the treasury securities, but also the corporate bonds as well. But in ordinary expansionary monetary policy, what they do is first they buy 10 let's say T-bills from a commercial bank, like let's say $10 million worth of commercial bank. So what happens first is, I put this as number 1, but that's first thing that happens. Since Federal Reserve buys T-bills for $10 million worth of T-bills, commercial banks, on the commercial bank's balance sheet, $10 million in T-bills go down, right? Its assets, T-bills were commercial banks' assets because T-bills pay interest, right? But Federal Reserve buys back T-bills. So T-bill balance will go down by 1 billion. in the commercial banks. And asset side, on the Federal Reserve's asset side, 10 million T-bills are there. So they have, increase of 10 million T-bills, $10 million worth of T-bills, right? So T-bill goes down first, commercial banks, on the commercial bank side. T-bill goes up in the Federal Reserve. That's assets for commercial bank. That's the asset for Federal Reserve. And then when you buy something, you have an obligation to pay. That creates an obligation. But so Federal Reserve, then this is what happens. Third, right? Number 3. What happens is then Federal Reserve simply creates accounts payable for $10 million in their liability side, right? In their liability side. In other words, no 10 million cash, no cash is being transferred, no cash transfers. Simply by creating accounts payable to 10 million of 10 million, then that creates at the same time that generates accounts receivable of 10 million in the commercial bank. It's also no cash has been transferred, but that's 10 million in reserve, right? That's 10 million in reserve. So on the asset side of the commercial bank, there is no change in terms of dollars. There is no change because originally there was 10 million in T-bills, but that went down. It decreased by 10 million. Instead, reserve of 10 million was created. The reserve of 10 million. So there is minus 10 million, plus 10 million. So in terms of $10 million dollar amount, no change. It's accounts, and for the commercial bank, it's accounts receivable. It's accounts receivable, right? Therefore, that gives the commercial bank the power to create loan up to 10 million, right? So this is how, and if somebody makes a loan, right? Of course, for 10 million, it could be multiple parties, but let's say one party, right? One party borrowed 10 million. Yeah, that way, and it's a company. So the company, with 10 million, the company, invests in its own expansion. Therefore, money propagates or proliferates, or money spreads out. Money supply spreads out throughout the economy, right? That's how the money supply increases and then stimulates the economy. So this is normally what happens in expansionary monetary policy. And I said, how does that then affect the Fed funds rate? So think about it. If so, this bank has $10 million in reserve, right? They want to make a loan, but nobody comes to borrow 10 million. Then what does the commercial bank do? They have, this is an excess reserve, meaning, they have already met the required reserve. So this 10 million is excess reserve. And then excess reserve is idling money. If you think about it, excess reserve is an idling fund. Isn't that right? Because money that is not being, the business of banking is in lending. By lending money, they make money. So $10 million sitting idling is actually, costing them the opportunity cost. So what do? Then they lend it to the Fed funds market. Think about it. They lend it to the Fed funds market. Now, suddenly there is $10 million more available to lend in the Fed funds market. So if there's 10 million additional $10 million in the Fed funds market, this is if there is additional $10 million in the Fed funds market, what's going to happen to the Fed funds rate? Anybody? Any
sorry,
guess?
repeat the question again, Professor.
Yeah, if there is suddenly, $10 million, additional $10 million available to lend in the Fed funds market, what's going to happen to the Fed funds rate?
The rate would be, I want to say, lower because they have extra money.
Yeah, the rate will have to go down. Why? Look, $10 million more available to lend. That means supply, increase the supply. So supply of funds increased by 10 million, right? And demand being held constant or demand being steady, suddenly if there's $10 million more, obviously, then the Fed funds rate must go down. Why? Because interest rate is I already explained this, I believe. At least since I teach four sections of this class, four sections, at least in 2 or 3 sections I talked about it, and I believe in this class I also talked about it. Interest rate is also a kind of price, isn't that right? Interest rate is a kind of price. Everybody's okay with that, right? Interest rate is a kind of price. So interest rate is a price for what? Can anybody tell me what is the interest rate the price for?
I feel like it's for lending the money. So pretty
No,
much
no,
so
no,
it
no,
can
no, no,
move
no.
around.
It's the other way around. I mean, interest rate is the price for when you are lending money. How come you're paying the price? When you lend money, you don't pay price.
Because you're holding it.
When you borrow money, you pay the price. Isn't that right? Isn't
You
it
can't
very
borrow
clear?
something for nothing. You have to have collateral of some sort. So you have to put up either.
No. Without collateral, don't worry about collateral. We are talking about in the Fed funds market. Is there any collateral between the banks,
Oh,
between the
okay,
commercial banks? Do they require any collateral?
Yeah.
And even let's say you are pay when you borrow money, when you borrow money, you pay interest. Isn't that right? When you borrow money, you pay interest. So interest is price for borrowing money, not for lending money. When you lend money, why do you pay price? Right? Doesn't it make sense? When you lend money, you charge. You don't pay, you
So you could get
charge.
a return. You need to get a return on your money.
Of course. So if you're the lender, you don't pay price for lending money. You understand? You charge money, you charge interest
And
for
this is
lending
from
money.
the
So
Fed's
interest
rate.
rate is the price for borrowing money.
This is from the
Okay?
Fed's rate to the banks. You're explaining the
No,
correlation.
in general,
Okay, in
of
general.
course,
All right.
in general, interest rate is the uh, price for borrowing money, right? And of course, if the interest rate is negative, you're paying price for lending. But who will do that? I mean, if the interest rate is negative, I'm not gonna put my money. I'm not gonna lend my money, right? That's what we talked about when we talked about negative real interest rate, right? Inflation and nominal interest rate. You remember that? So please, the logic is very clear, right? The logic is very clear. Um, it's a very clear, and simple and straightforward logic. Don't try to don't try to beat around the bush. Okay, just focus on the core of the logic, and if you focus on the core of the logic, it's very simple and straightforward and very clear, right? You, uh, Interest rate is price for borrowing money. If you borrow money, you pay interest, right? If you lend money, you charge interest. You receive interest. In other words, you receive payment, right? You receive payment for lending money, but otherwise, you wouldn't lend. I wouldn't lend. I wouldn't put my money in the bank if bank charges interest for putting my money in the bank, right? Think about it. This is just the logical reasoning. So that's so then think about it. We're now we are back to the Federal Reserve and the Fed funds market. I mean, Fed funds. So bank, commercial bank that has $10 million suddenly in excess reserve, will, and nobody's coming to borrow money. This $10 million. What do? They put it into the Fed funds market, and as there's more supply of money, right? There's more supply of funds in the Fed funds market, and Fed funds rate will go down. Will have to drop, and I believe Peter, you gave me that answer, didn't you,
Yes.
Peter?
Yes.
Right. So I'm just looking for my pen. Where did it? I tried. I'm looking for my pen to
Thank you, Professor.
make note of that. Alrighty. So you'll get 0.25 for that. But just where's my pen? Where did it go? Alrighty. I'll just use another one. So today is 0930, and this is fnb100 section 1400. Okay, so Peter 0.25. All righty. So that explains, now the discussion is complete. I mean, the cycle is complete. The logical the mechanism is complete now. How the Fed funds rate, Federal Reserve affects the Fed funds rate through the open market operation. Okay, this way, now, so we are done with the. Okay, I already even closed the. So I was also talking about in other sections. I was also talking about. Let me open. Where is it? $100. So we already talked about this part. We already talked about. Now we introduced a new symbol called. I'm gonna get to that later. So let's think about the risk. I mean, in the financial market, in lending. Also, because bond is basically, if you're buying, if as an investor, if you're investing in bond, you're lending money, right? Clearly, that's why and as you, but in the stock market, you are not lending money. You're actually buying part of the ownership So then, there are slightly different natures of risk, but um, in the bond market, especially in the context of lending, the greatest risk you are facing is the default risk. We already understand. We talked about the default risk because if you're lending money, your biggest concern is whether you can get your money back, right? And that means whether the borrower will default or not, right? So default risk is the greatest risk. But other than the default risk, what other types of risks are there? Of course, in terms of default risk, we can pretty much limit our risk exposure because all the borrowers, in other words, the companies, right? Not only the companies, but the governments. The government debt or the treasury, right? That's the federal government debt and other national government's debt. Government debts are called in general sovereign debt, sovereign, right? Debt of a sovereign nation, right? Sovereign debt. And all the borrowers have risk ratings, right? Like AAA, AA, single A, triple B, double B, and so on. So if you are triple B and above are investment grade, right? Below triple B are considered risky. So if you are, investing in bond, at least you can limit your risk exposure, right? And you can understand easily that as the risk rating goes down, their coupon rate will go up, right? Make sense? Because the lower the credit rating, the greater the risk, right? So they will have to pay higher interest to compensate for that risk. So that if you think about it, the coupon interest rate that's going up, together with the downgrading of the credit worthiness, is a kind of default risk premium. It's the premium they have to pay to compensate for that default risk. Right? Makes sense? Does everyone follow so far?
Professor. Yes, Professor.
Okay.
Somewhat.
Okay, at least I know, Peter, you are following. But what about the other people? Do the other people also follow? Stacy, are you following? Stacy?
Yes,
Trying to
Professor.
keep
Okay.
up
Yes.
over here.
All
Trying to keep
righty,
up.
Eva and Edgar following. Good, good. I don't know about the other people. They're just like dormant, right? These
Yeah,
icons
I was
are
being
dormant.
pretty
Okay,
dormant.
I got you. All right, Dexton, I got you.
Yeah,
All
I'm
right,
following.
all righty. Please don't make your icons. What do you call that? These icons or symbols. Don't make your icons look dormant. Huh? When the microphones are lighting up, then I know you are there, breathing and kicking. But if I don't see any reaction, I get the impression that those people are dormant, right? Now, so then, other than the default risk, what other risks are there? There are three more types of risks. Three more. The default risk is the first one. Second one, liquidity risk. Third one, maturity risk. And what's the fourth one? It's not. I didn't put it here, but we already know it. Inflation risk. Inflation risk. So I didn't put it there. And think about it. Inflation, default risk, and liquidity risk are like firm specific, right? But the maturity risk and the inflation risk are not firm specific. It's across the board. Every company. Excuse me. Because inflation is a macroeconomic phenomenon. It affects everyone and every company, every business across the board. It's not firm specific, right? So two types of risks are firm specific, and two types are firm independent, or across the board, right? Systemic, because they are systemic. Now, a default risk, we can understand. What is the liquidity risk? Liquidity risk is the risk associated with being unable to sell the bond of a little-known issuer. A company that is not well-known, little-known company, their bond is hard to sell, right? Because they are not very well-known. And if they are not very well-known, but of course they are listed in the bond market. That means they meet certain criteria, certain criteria, right? But they are little known, and obviously you will be hesitating. Obviously, I don't know that. I haven't heard of that company. What are they doing? But so most likely if they're a new company, they could have low credit rating, or even if they are new, that doesn't mean they will always have to have a low credit rating. They could have, in terms of their financial strength, in their financial soundness, they may be very financially sound. So they can be still like at least A rated, but they are not very well known. That's why such a company will have to pay a premium in coupon rate. The premiums are all in coupon rate. So that's a liquidity risk. Liquidity meaning not easy to liquidate, not easy to turn into cash, right? Not easy to turn into cash, right? I mean, if liquidity is high, of course, easy to convert into cash. Liquidity is low, difficult to convert into cash. Now, the maturity risk is the risk associated with uncertainty. I mean, basically uncertainty related to time. The longer the maturity, think about it. Compare 1-year bond with 30-year bond. Which one do you think has more risk?
The 30-year bond.
Yeah, 30-year bond. Yes, of course.
Time.
Yeah, because lots of things can happen over 30 years, right? I mean, time is already uncertainty. Time poses this uncertainty issue, because if a bond matures in 1 year, in 1 year or within 1 year, pretty much everything about it is obvious. It's already well known. In other words, think about it. One thing is very clear about the bond. One thing is very certain about the bond. What is that one thing? The coupon interest, right? If the coupon rate is 10%, it will be 10% through and through until the end of the maturity. So a 30-year bond with 10% coupon, we know that this 10% coupon interest will be throughout the entire maturity of the bond. But then what are the other factors that are uncertain? The other factors are inflation and interest rate. Okay, now when I say interest rate, it means different other things. I mean, there isn't only one single interest rate. We already know there is a simple interest rate, compound interest rate, nominal interest rate versus real interest rate, uh, borrowing rate versus lending rate, but and also coupon interest rate versus what? Coupon interest rate versus prevailing rate in the market, prevailing interest rate in the market, or the going rate in the market, or average interest rate in the market, right? You understand? So two things that are uncertain is how the market interest rate will change, because the market interest rate is the prevailing rate in the market is what is being used as the discount rate to find the present value when it's a valuation factor, right? To value the bond, you need the prevailing rate in the market. Prevailing rate in the market can change anytime. I mean, Fed funds rate changes every day, right? Fed funds rate changes every day. And Fed funds rate is a very typical example benchmark for short-term interest rate. The long-term interest rate benchmark for the long-term interest rate is the yield on 10-year Treasury note, 10-year Treasury note yield. So based on the 10-year Treasury note, yield also changes every day. Yield is the return, because daily, the return will be different. But let's say fluctuating rate is not a big. Daily fluctuation is not a big deal, because bond is not as volatile as stock, right? Bond prices, fluctuate every day, but the range of variance, the variance is relatively, very small compared to how stocks, the variance of the stock price. So it's not a big deal, but let's say over 30-year period, Federal Reserve can, raise or lower interest rates a number of times over 30 years, and we don't know how it's gonna change. And you understand already that you understand the inverse relationship between the bond price and the interest rate, right? You understand the when bond price goes down, interest rate goes up, price goes up, interest rate goes down, right? So think about it. When we don't know over 30 years, right, how often the Federal Reserve will change the interest rate. Over 30 years, maybe at least it all depend on the whether the economy is in recession or falls into recession or gets overheated. But let's say the business cycle has been relatively longer than the past. Prior to 1990s, the business cycle was at least like 4 years. Within 4 years, we have a whole cycle. But post 1990s, the cycle has got longer. I mean, very short burst of recession, and then long, prolonged, and slow recovery. The cycle takes at least about 8 to 10 years. So 30 years, even that, there will be at least 3 to 4, 5 cycles. So we can expect, about 8 to 10 interest rate changes. But whether, we don't know whether, we don't know for sure, because 30 years is such a long time. No economic forecast beyond 2 years is really reliable, right? And anything within 1 year is quite certain. We know there's going to be no interest rate change, or whether there's going to be interest rate. If there's going to be interest rate change, there will always be, Federal Reserve chair on a press conference after FOMC meeting. FOMC meets, like 8 times a year, and after each meeting, Jerome Powell, the Fed chairman, holds a press conference, and basically, it's called guidance. They are giving guidance, Federal Reserve guidance, what the monetary policy will be like, whether the interest rate will go up or go down. So at least because Federal Reserve holds the press conference and releases the guidance, we know whether the interest rate will go up or go down within 1 or 2 years. And within 1 year, we know for certain. So, but there's no uncertainty about interest rate movement within 1 year. And about the inflation, we are pretty, we have pretty good idea, so we can react to that. But over 30 years, there is no way of knowing how the interest rate will change. And think about it. It's gonna be a disaster. It's a negative sign. I mean, it's an adverse event if interest rate goes up, right? Why? If interest rate goes up, we all know that's a bad thing for the economy. That's negative for the economy. Also, when there's an inverse relationship between the bond price and the interest rate. So if interest rate goes up, bond price goes down. And if you have bond holdings, then your bond value of your bond holdings go down, and that would be a bad time to sell, right? And we don't know over 30 years, in the long term, everything is uncertainty. So that's why the maturity, there is a risk associated with maturity. Therefore, maturity risk goes by different other names. It's also called interest rate risk because it's caused by the longer the maturity, higher the uncertainty about the interest rate, and then also called price risk because if interest rate goes up, price goes down, right? The valuation goes down. So that is what's called maturity risk. So overall, we come to this conclusion. K stands for cost of capital. Cost of capital means, so do we need, additional interpretation of that? Now, think about it. Nobody explained what, without anybody, nobody needs to explain. When I was a graduate student, this is analytical thinking and logical reasoning. Oh, why is it called cost of capital? What does that mean? Oh, it just through, logical reasoning, I came to my own conclusion. Oh, that's cost for borrowing money, cost for raising capital, cost for raising capital. So hence is cost of capital, right? And then that means interest rate, isn't it right? Cost of raising capital is the same thing as cost for borrowing money. So cost of capital K, that's also lowercase, always lowercase. That's the symbol for another symbol for interest rate. So the structure of the interest rate is basically pure return, right? So this is real interest rate, pure return, pure rate, pure return. That's real interest rate plus inflation adjustment. In other words, inflation premium. So now, if you think about it, from here to here, that's something we defined as nominal interest rate. Isn't that right? That's what we defined as nominal interest rate. But at the time, to make it simple, to keep it simple, we didn't incorporate other risks. But if we fully reflect the other risks, then there's default risk premium. That makes what everyone's borrowing rates are different when you borrow money from the bank, right? So it's the lending rate from the bank's perspective. Everyone's borrowing rate is different, right? Default risk. And then the liquidity risk and the maturity risk, okay? Default risk ranges generally between 0 to 8%. Maturity risk ranges between 0 to 2%. Liquidity risk could be also ranges between 0 to 2%. So, and pure return, conventionally, real interest rate is about 2%. Inflation, let's say about 2%. So that already is 4%, right? And you are not a company, you are an individual. As a person, if you have excellent credit score, you are in prime category. If you're in prime category, your rate will be just 3% above Fed funds rate. So yeah, that is both pure return plus inflation adjustment. And so if you get about 3.25, right, 3.25 or 3.5, then yeah, that's exactly the nominal rate for someone in the prime category. And then if you have a very bad credit score, then default risk premium will be added, which will be a maximum probably around 8 to 10%. So then think about it. About 4% plus 8%, that's already 12%, and then 2% here, that will make it that can be like 16%, right? But this is theoretically how the interest rate is constructed. I mean, this is the decomposition of the interest rate, right? Decomposition. But then this is just a theoretical model. In reality, it's hard to draw the line. There's a very fine line between everything, right? All right. So that wraps up everything about this first topic. So we are now moving on to the second topic, which is financial statements, and I'm gonna have to. Alrighty, I think that was roster for section 1100. I just. Financial statements refer to four statements. They are typically income statement, balance sheet, cash flow analysis, and retained earnings statement. Now, cash. We will talk about only the balance sheet and income statement in this course, because cash flow analysis is analysis of income statement and balance sheet. So the name, so the income statement and balance sheet are the primary statements, and cash flow analysis and retained earnings statements are secondary statements. When I say secondary, it doesn't mean it's less important. It's less important, but they use the data. They use the cash flow statement is literally the analysis of income statement and a balance sheet. So the name is cash flow analysis. So we will need to in Finance 230, we delve into cash flow analysis more in depth. Okay, we talk about it in Finance 230. So because cash flow, if you don't have income statement and balance sheet, you cannot have cash flow analysis, because you use the data collected from data compiled from income statement and balance sheet to conduct cash flow analysis. So that's why I'm saying it's secondary statement. So cash flow analysis is relatively compared to a retained earnings statement, a cash flow analysis is more difficult, more complex, or more involved, more complex than retained earnings. retained earnings statement is relatively straightforward. But it also uses the data compiled from balance sheet. Uh, so that's why it is secondary statement. Primary statement, income statement and balance sheet. This is the starting point, and that's really the balls and knuckles of bones and knuckles of finance. And it's also called fundamental analysis because financial fundamentals, all financial fundamentals are based on these, financial income statement and balance sheet. And you trust nothing, but you should trust the nothing else but the financial statements. Of course, as the basis for data. But again, they can cook the book. So when I said, this is something to rely on, I mean, that's provided that the statement is, not cooked, right? It's, true statement, only if it is a true statement. Yeah. So first of all, what I want to emphasize, I mean, I want to make a clear distinction here, because people, even after, I mean, this is something you encounter also in accounting, but even after taking the accounting class, the students get confused. Students get confused about the line items. The line items in the balance sheet and the line items in the income statement are all different. Okay, there are only two line items that are common to both statements, but basically all line items are different. But even after taking accounting class, students very often can't tell the difference. They can't tell whether it is, it belongs to the income statement only or whether it belongs to the balance sheet. It gets all mixed up. It gets all chaotic. And it's because mainly I would, my theory is, first of all, it's only natural. It's only natural. You get only good after it takes a lot of practice. You have to practice. You have to revisit it over and over and over again until it sticks to you. But it's just one semester, once the semester is over, everything is, taking the back seat. I mean, it's not really committed to your long-term memory. Your short-term memory is being purged. Your short-term memory purges everything before you repeat it over and over. I mean, the only thing you can commit the short-term, whatever you have in short-term memory, to commit it to the long-term memory, you need to repeat. You need to repeat it over and over, and then it gets committed to the long-term memory. But if you don't do that, in your short-term memory, it's retained for a while, but it has to be purged to make room for the new information. And so it gets purged, and then you will remember nothing later. That's one reason. Second reason, in accounting class, they don't tell you, they don't focus on why. They don't focus on the reasoning behind it. Why this line item comes here, why this line item comes first and not after the other item, the other line item. Why this is named as such, right? Why this line item is named such, and so on, etc., etc. I mean, all these kinds of questions require asking why. But then in accounting class, they don't ask why. They just mechanically follow the preset or prefabricated preset procedure. So then you can memorize. You can memorize the procedure, but then you can't explain why this is being done at this point and why it is named, why it is called by this name. Well, those things you don't know, right? That's the downside of accounting class. They don't focus on why. Now, so in this class we focus on why. Okay, we focus on why. So the first thing I want to focus on is what are the purposes of income statement and balance sheet. And I would like, and I also want to say, the first thing I want to say is these two statements serve two different purposes. Income statement, purpose of income statement and purpose of the balance sheet are totally different. They serve different purposes. So that's why their line items are all different. And quite often, students think it has something to do with profit. I mean, of course, businesses, all businesses, basically the goal of all businesses is to, can anybody answer me? Can anybody give an answer to this question? What is the objective of all businesses?
To contribute something to society.
No. Please. That's their front. That's their cover. Right? What kind of, it's a non-profit.
To make profits.
Oh. Huh? Did someone say what?
I was gonna say to make profits, but you said it's a non-profit.
To make profit. Okay. Who said to make profit? Who said?
I did.
Yeah. I don't know who is I. So please state your name.
Oh, Daxton. Sorry, Daxton.
Daxton. Okay. Daxton. I'll give you 0.25 for that. Okay, but that was not. That was close enough to make profit, yes. But any level of profit, think about it. Is any level of profit? Is any level of profit okay?
To maximize it.
Yes, that's the correct answer. To maximize profit. Daxton, I'll give you another 0.25 for that. So, I mean, if you said, to maximize profit, that's the goal of any business, yeah, you would have got 0.5 in the first place. You got 0.5 because at first you said to make profit. Even for that you got 0.25.
Okay.
But for additional, you got additional 0.25 by saying to maximize profit. Yeah, think about it. There's when I ask this question, some students say to make money. But what is make money? What does that mean? That's fake, because I work and I get paycheck. That's making money, right? Right? But in case of business, they sell something, right? All the businesses basically sell something. All the businesses, they sell something. And so for selling something, they bring in revenue. That's like my paycheck. They bring in revenue, but then revenue is not everything, because think about it. They have expenses. They have cost. I mean, a manufacturer makes something, but to make something, they have direct cost and indirect cost. I mean, they have think about it. They have production costs, first of all, right? And then there are indirect cost. So they have to subtract this cost from the revenue, right? And then if you subtract those expenses from the income, then it's called profit. But that's not the exact term. And it's not net profit just yet. It's roughly just called profit. It's called it's called operating profit. And then you have to pay taxes from the operating profit. Only after paying taxes, then you are arriving at net profit. But is my salary the same thing as profit? No. My salary is pre-tax and pre-expense. Isn't that right? My salary is like the gross income. My salary is just the gross income, right? So it's like the revenue, gross revenue of a company. So I have to subtract, taxes and expenses, expenses and taxes from that, and I arrive at then whatever is left is my savings, right? Whether I save it or not. Think about it. From my salary, I have to pay, rent, mortgage. If you have a house, mortgage, not rent. If you rent,
expenses, liabilities too.
Broad, umbrella, expenses. It's a broad, umbrella term is, expenses, right? But my expenses are basically basic necessities of life: food, shelter, clothing. Food, shelter, clothing, isn't that right? Food, shelter, clothing, and shelter. That's rent, paying rent, or if you have a house, mortgage, paying mortgage. And then those are bare necessities. And after that, there's transportation and telecommunication. Transportation cost, telecommunication cost. Heating may be included in your rent. But if you own your own house, there's energy bill, energy, heating and cooling. So, but at least bare necessities. Even if you truncate it to the bare necessities, we have at least 3: food, shelter, clothing, and expend it to like 5 items. Transportation and telecommunication. Right? You have to subtract that, and then subtract taxes, and whatever is left. And then what? You're not just living frugally. Let's say you have social life and etc. Entertainment. Yeah, subtract all that. Whatever is left, then that's your savings. If there's nothing left, you better cut down on your social life and entertainment, right? Whatever is not the bare necessities, you gotta cut down. And then after paying taxes, whatever is left is your savings. And the savings can be invested, right? So think about it. Making money, make money. Where did I make money? At what level? The salary, that's making money for me, right? For businesses, making money means what? Profit. Making profit means making money. So if you say make money, goal of the business is to make money, that's very vague, right? It doesn't get even 0.25. Such an answer doesn't even get 0.25. But if you say make profit, that can deserve 0.25. But any level of profit, no. For example, Best Buy is a retailer, right? Consumer electronics retailer, buys a computer from Dell, and they pay $300 for that computer. And if they sell, of course, they will sell it above their cost. Their cost is $300 because they pay. That's what they paid the manufacturer Dell. So if they, but if they sell at 301, did they make money? Yes, they made money. That's layman's term. But if you say, if you're, trained in finance and economics, or at least, if you have some college education, you would know. You should say they made profit, but they made just $1 profit, right? So is that acceptable? No, it's not acceptable, right? They want to maximize that profit, right? Actually, that is not. So if Best Buy bought the computer from Dell for $300, then the profit margin should. It's actually a more technical term is markup. They mark it up by $200. They mark it up by $200, and that means they sell it for 500. Then in the $200 markup, the $200 markup breaks down into first overhead and profit. Overhead and profit. What is overhead? Overhead is operating expenses plus taxes, right? So overhead part, that overhead, operating expenses and interest payment and taxes, that's overhead. So this $200, let's say 50 is their profit, and then 150 is overhead. So the whole thing is called markup. But it's a long story, so we're already out of time. So we'll discuss this further in our next class on Tuesday. Okay. So please, everyone, I already talked about this about the connect at the beginning of the class. So please, don't forget to get started already, because once the 2 weeks are up, I mean, someone that activates it first sets off the clock, right? So you don't have next day, tomorrow, you won't have 14 days left. You will have only 13 days left. The more you delay.
But when are we all starting it? So when are we all starting it? So when are we all going to start it? When will we all start it?
You must start now. You must start today.
Okay.
Right? Yeah, and I showed you where to go for, I put it on the course information. All right. So, alrighty. So I'll see you guys on next Tuesday. Have a great afternoon. And
All right. See you, Professor.
You too.
okie dokie. Take care, everyone.
Bye.
All right. All right. Take care. All righty, Mamadou. I will stop sharing and stop recording and signing out.